We are Group D and we will introduce some significant questions about financial accounting B. The first question is, what is impression management? Impression management was first conceptualized by Alvin Goff. His dramaturgic model argues that our lives are a set of performance. In other words, impression can be managed by controlling information they want to convey through social interaction. There are several perspectives about impression management. They are economic, psychological, sociological, and critical. Let's focus on the economic purpose at first. Managing impressions play a very important role in operation performance to restore reputations, which arise from agency scenery, such as reporting bias. For psychological purpose, managers will use self-serving bias to mask their operational performance to shareholders in order to win rewards, which arise from attribution scenery. Let's focus on the second question. What is earning restatement? An earning restatement, also called earning recast. There are several reasons for restatement, like material inaccuracy, accounting errors, and non-compliance with GAAP. Earning restatement does not mean to adjust financial statements at discretionary attitude, so it's significant to mention that a negative restatement often shakes investors' confidence. On the one side, it's beneficial reason like aiding financial decision. On the other, it will be bad manipulation for personal profit.
Why managers engage in earning restatement? Well, we will discuss the question from two aspects. First, for the stakeholders, managers can use techniques within the conceptual and regulatory framework to present earnings appropriate figures. It is in the scope of creative accounting and it is legal. Then, if new information or new calculation methods appear, previously reported earnings figures need to be revised to be consistent. For example, generic electric reduces 2016 and 2017 earnings and revenue after accounting restatement because new revenue recognition rules are issued by the Financial Accounting Standard Board in 2014. For GE, this especially applies to its long-term service contracts, so it needs to restate its earnings. Its managers believe that investors and stock market prefer earnings that are smooth, rather than volatile, and predictable, rather than unpredictable. Lastly, if there are some accounting scandals, public pressure and government requisition can push managers to restate earnings. From the manager's aspects, earnings can be a measurement of stewardship. So they manage earnings to satisfy shareholders, thus achieving their own personal gains bonus or concealing their underperformance. What's more, they also restate earnings to mix tax purposes. They can deal with the dividend and interest expenses to adjust tax. To conclude, earnings restatement can not only meet the stakeholders' needs, it can also meet the needs of the manager.
In this question, we look at the company Polypack in which earning restatements were made, which will be shown through disclosures and explain how managers use earning impression management in their earnings restatements. To begin, here is a brief history on Polypack. Polypack is a small British textiles company which grew and expanded before ending in the collapse of the company in the space of 51 years. At the company's peak, it expanded and owned Europe's largest electronic companies, hotel and leisure complexes, and the global fruit brand Del Monte. The company was worth $1.6 million by 1989, and in the 1990s, the Serious Fraud Office began investigating to find that the CEO of Polypack had moved a total of $146 million out of Polypack.
Now let's find out how did Polypack attract the investors. As shown in the slide, we have Polypack International in London and subsidiary in Turkey. Suppose the parent company made a loan of £10,000 with 5% of interest rate, so the cost is £500, and then the money flows to the overseas subsidiary. And to simplify it, we just assume the exchange rate is 1-to-1, so there will be 10,000 Turkish liras. And the money will be invested into the operations with high rate of return. Let's assume that's 20%, so the payback is 2,000 Turkish liras. But that's not the point.
Actually, Turkish lira is a weaker currency, so it's reasonable to assume that it will be weaker and weaker. Let's change the exchange rate to the 1 to 2. So finally, the initial investment will only have £5,000 value, and the payback will only have £1,000 of value. So what will happen now to the Polypack financials reporting? Let's see, in the income statement, they have the income of £1,000 while the cost of £500, so that gives a profit of £500. That's good news for investors. However, actually in balance sheet, they have a liability of £10,000 while they only have the capital of £5,000. So actually the equity is crushed by £5,000. Unfortunately, investors just overlook this point, and that's how Nadia used the impression management technique to manipulate the profit.
As is mentioned before, the income of Polypack was manipulated. The manager's strategy forecasting the company's profit or image was to change its year-end from August to September in 1988. It was the second time in its history to change the year-end, so audited figures for its performance were not published until April 1989, and then the group's profit continued to grow steadily in 1988. Polypack's pre-tax profits advanced satisfyingly into 3 figures for the first time. Turnover shot up even faster. Polypack's 16-month accounts were published on 12th of April 1989 as a result of change in the year-end. The result was slightly ahead of the forecast made in the previous autumn. Here is Mr. Nadir said in his chairman report in 1989. Mr. Nadir uses impression management to shape Polypack as a profitable company. Facing huge profit growth, investors ignored the fact that the gearing ratio of Polypack was at a alarm level. Meanwhile, the changes in year-end avoid comparison with company at the same level hide 2 problems within Polypack. The first one is a very high level of debt, much higher than outsiders tend to realize. And the second one is the shortage of cash flow. And these are 2 significant reasons cause Polypack to fail.
In conclusion, we see that earning restatements are made through a variety of ways which have made the company seem more profitable in the profit and loss statements, which leads to the capital in the balance sheet to be continuously crashing. There is a large amount of impression management techniques used, as explained earlier, such as showing a large profit growth and a high gearing ratio, to which investors focus on the growth and neglected the latter, as well as avoiding the ability for the company to be comparable by changing the year-end date, and finally not explicitly showing the high level of debt and regular cash shortages. We see the use of positive acclaiming theory, in which Polypack shows to stress the positive aspects of the company and downplay all the negatives.